Welcome back to Marginal Thoughts.
Good to be here.
So today we're jumping into a financial topic that's, well, it's everywhere lately. Lots of buzz, lots of strong feelings.
Ah, you must mean annuities.
Exactly. Annuities. You see these huge numbers, sales hitting, what, over $430 billion just last year?
That's right. And the projection is over $1 trillion between 2022 and 2024. A massive amount of money.
It's incredible. But then you look around, you talk to people, and it's completely split. You hear they're essential, for retirement income, like your own personal pension.
Right. Guaranteed income for life, that's the pitch often.
But then the next person tells you to run away screaming, warning about crazy fees, complex contracts you need a lawyer for.
Yeah, it's definitely polarized, and that makes it really tough if you're just, trying to figure it all out for the first time.
Which is exactly why we're tackling this today. We had a listener send in some material asking us to basically start from square one. What are these things? Are they ever right for someone who, frankly, knows almost nothing about them?
Right. So the goal here for this exploration is to try and cut through some of that noise. We'll break down the basics, what an annuity actually is, the main ways they work, why they've gotten so popular all of a sudden, and crucially for you listening, lay out the real pros and cons based on what we've seen.
Yeah, we want to give you some clear insights so you can feel a bit more informed when you hear about these things. So I'll kind of guide us through the points raised, and I'll be relying on you for the expert breakdown and context. Ready to jump in?
Let's do it.
Okay, so super basic level. For someone hearing this term maybe for the first time, what is an annuity at its heart?
Okay, think of it like this. It's basically a contract. You make it with an insurance company.
An insurance company.
Yeah. You give them money, could be one lump sum, could be payments over time, and in return, they promise they'll pay you back later, usually as a regular income stream.
Ah, okay, so income later.
Yeah.
Often for retirement, I guess.
That's the most common use, yeah. Sometimes it's designed to pay out for your entire life. So you're kind of transferring the risk of outliving your savings to the insurance company.
Interesting. Like buying insurance against running out of money.
Yeah.
So I give them a chunk now, they promise me, say, $500 a month later on.
That's the core idea, precisely. It's insurance for longevity for your retirement income.
Got it. Okay. The material mentioned different timings. Immediate versus deferred. Sounds simple, but what's the difference in practice?
Yeah, it's just about when those income payments start. Immediate annuity, you give them the money, and bam, the payments start pretty much right away, usually within a year.
Okay. Who does that?
That's mostly for someone who's already retired or like right on the doorstep and needs that income stream now.
Right, makes sense. And deferred must mean later.
You got it. Deferred means the income starts at some future date you pick. Could be many years away, when you actually plan to retire.
And the money I put in, it just sit there.
No, typically it grows during that deferral period. And that growth is tax deferred, which is a feature we should talk more about later.
Okay, tax deferred growth until payments start. Got it. So timing makes sense. Now, the part that seems way more complex is how the money grows before you take income. This is where terms like fixed, variable, indexed come in. Let's start easy. Fixed. Sounds safe.
It is the simplest, yeah. A fixed annuity, think of it a bit like a CD from a bank, but it's from an insurance company. They guarantee you a specific interest rate for a set number of years, and your initial money, your principal, is protected. It won't go down if the market tanks.
Okay, so guaranteed rate, money's safe from market crashes.
Yeah.
Simple enough, predictable.
Exactly. Stability, principal protection. You know what you're getting for that fixed period.
Okay. Then variable. Sounds like the opposite.
It pretty much is. With a variable annuity, your money isn't just earning a fixed rate. It's invested in things called sub-accounts.
Sub-accounts. Like what?
They're basically investment portfolios, very similar to mutual funds. You might choose stock funds, bond funds, that kind of thing.
Ah, so my return depends on how those investments do.
Directly. If your chosen funds go up, your annuity value grows. But, and this is the key difference from fixed, if those investments go down,
my account loses money.
Correct. Your principal is at risk. It acts much more like investing directly in the market just inside this annuity wrapper.
So wait. If it's like investing but riskier than fixed, why do it in an annuity? Does it have other benefits?
Well, it still offers tax deferral on the growth. And sometimes they offer optional riders for extra cost, like death benefits or income guarantees. But a big point often raised is the cost.
How so?
Variable annuities often have, well, multiple layers of fees. You've got the fees for the underlying investments, like mutual fund fees. Then you often have insurance charges on top, mortality and expense fees, administrative fees. It can add up.
Okay, so potentially much higher cost than just investing directly.
Often, yes. That's a major criticism. You're paying for the annuity structure itself on top of investment costs.
Got it. Fixed is stable, variable is market-linked with risk, and potentially higher fees. Now, for the one that sounds tricky, indexed annuities, sometimes called fixed index annuities or FIAs.
Yes, these are definitely more complex, and that complexity is, frankly, one of the biggest knocks against them.
Okay, break it down. How do FIAs work?
So FIAs link your potential earnings to a market index, like the S&P 500. But, and this is crucial, your money isn't actually invested in the index.
It's not. Then how? How does it get returns based on the index? That sounds weird.
It is a bit weird. It's based on how the insurance company credits interest. They watch the index. If the index goes up over a certain period, they credit your annuity with interest based on that gain.
Okay, based on the gain. Is there a catch?
Usually, yes, there are limits. They might use a cap, meaning there's a maximum percentage return you can get, even if the index skyrockets.
So if the market gains 20% but the cap is 8%, I only get 8%.
Exactly. Or they might use a participation rate, meaning you only get a certain percentage of the index's gain. Maybe 60% participation means if the index gains 10%, you get 6%.
Okay, so limited upside. What's the appeal then?
The appeal is the downside protection. Typically, in a traditional FIA, if the index goes down, your account value doesn't decrease due to that market loss. You might just earn zero interest for that period.
The zero is your hero idea. You get some market upside potential, but protection if the market falls.
That's the core trade-off, and why they appeal to people nervous about market crashes. You give up some potential gains to protect your principal from market losses.
Okay, protection but with limits on growth. Then the material also mentioned RLAs, registered index-linked annuities, said they were growing fast. Are they similar?
They're related, sort of a newer hybrid. RLAs, like FIAs, are linked to an index, but here's the difference. With RILA, you usually do accept some potential loss if the index drops.
Oh, how does that work?
They offer what's called a buffer, or a floor. A buffer might protect you against, say, the first 10% of a market loss. If the index drops 15%, you'd only lose the amount beyond the buffer, so you'd lose 5%.
I see. So not zero downside like an FIA, but the loss is limited.
Exactly. Or a floor might set a maximum loss. Say, you won't lose more than 10% no matter how far the index falls.
And why accept some loss? What's the trade-off there?
In exchange for taking on that defined, limited downside risk, RILAs can often offer potentially higher caps or participation rates on the upside, maybe even untapped potential sometimes, or leveraged gains. They're for people who want more market growth potential than an FIA, but still want a defined level of protection.
Okay, wow. That's a lot to take in. Let's just recap quickly. Fixed, simple, safe, guaranteed rate. Variable market investments, market risk, potential for higher fees. Indexed, FIA, index-linked gains with caps limits, usually principal protected from market loss, RILA, index-linked. But you take some limited downside risk for potentially better upside.
That's a good summary. The key is they're all different beasts with different risk and reward profiles, not just one thing called annuity.
Right. So given this variety and complexity, why the huge sales surge? You mentioned the numbers earlier. What's driving that?
A couple of big things seem to be at play. One major factor, interest rates went up.
How does that affect annuities?
Well, when rates are higher, insurance companies can offer much more attractive guaranteed rates on their fixed annuities. Suddenly, they look pretty good compared to, say, CDs or some bonds.
Oh, okay.
And higher rates can also allow them to offer better caps or participation rates on the index products, too. So the products themselves just looked better, more appealing than they did when rates were near zero.
Makes sense. People locking in those higher guaranteed rates. What else?
The other big one is probably market volatility. Fear.
People getting spooked by the stock market ups and downs.
Absolutely. You know, after we saw periods where both stocks and bonds lost value, which is unusual, people got nervous about losing money, especially nearing retirement.
Understandable.
And when people are scared, that promise of guaranteed income or protection from market drops, even with the limits we discussed, starts sounding really, really good. It plays on that fear of loss.
Yeah, that makes sense. Fear is a powerful motivator. Which leads us right into the criticisms, because that promise of guarantees, It definitely comes with some serious potential downsides people need to know about, right?
Oh, definitely. And the material we looked at was pretty blunt about these, especially for beginners. The big ones that kept coming up were costs and complexity.
Let's hit costs first. They can be expensive.
Yes, they really can be. Compared to just buying, say, low-cost index funds or ETFs in your IRA or 401k, annuities often carry significant extra fees.
Like what kinds of fees?
Well, in variable annuities, you often have administrative fees, insurance charges called M&E fees, mortality and expense, plus the fees of the underlying investment funds themselves. Then you can have extra fees for any optional riders you add, like income guarantees. It can add up to, 2%, 3%, sometimes even more per year.
Wow, that eats into returns significantly over time.
Hugely. Even with fixed index annuities, while they might advertise no annual fee, the cost can be sort of hidden in the lower caps or participation rates they offer you, or they charge quite a bit for those optional riders. The bottom line is, those guarantees and protections aren't free.
You're paying for them, one way or another.
Absolutely. And figuring out exactly what you're paying and how is tough, which brings us to the complexity issue.
Right, the contracts themselves, described as massive and full of jargon.
They really can be. Annuity contracts are often incredibly long, very dense, full of legal and financial terms that are, frankly, difficult for most people to fully understand.
Yeah, I can imagine.
Trying to figure out all the rules, the exact fee structure, how the index crediting really works with all its limits, what the riders promise and what they don't. It takes serious effort. It's easy to miss important details.
Making it easy to buy something you don't fully get.
Yeah.
And connected to that, something else that got a lot of attention. The commissions. The money paid to the person selling the annuity.
Yes, this is a really thorny area and a major source of criticism. The commissions paid to agents or advisors for selling annuities are often much higher than for selling simpler investments like mutual funds.
How much higher are we talking?
The examples given were pretty stark. Like if you roll over, say, $500,000 from a 401k, putting it into typical mutual funds might pay the advisor maybe $10,000.
Okay.
But putting that same $500,000 into certain types of annuities could pay that advisor $30,000, $40,000, maybe even more.
Whoa, wait. 40 grand versus 10 grand?
Right.
That's a massive difference.
It's huge, and you can immediately see the problem, right?
Yeah, it creates a huge incentive for the advisor to recommend the annuity, whether it's truly the best thing for me or not. Their payday is much bigger.
Exactly. It creates a serious potential conflict of interest. Are they recommending it because it's right for you, or because it pays them 3 or 4 times as much? That's a question consumers really need to be aware of.
That really puts the buyer in a tough spot, especially if they don't understand the product's complexity. And that seems linked to another big negative. Getting your money out if you need it. Surrender charges. They sound painful.
They are. They're a major drawback. Annuities are meant to be long-term commitments, usually for retirement income. If you need to pull out a significant chunk of your money early on during what's called the surrender period,
How long is that period?
it varies, but typically it can be anywhere from, say, 6 to 10 years, sometimes longer on certain products. During that time, if you withdraw more than a small allowed amount, the insurance company hits you with a surrender charge.
A penalty, basically.
A penalty, yeah. And it can be substantial. It might start at, say, 8% or 10% of the money you take out in the first year, and then it gradually declines over the surrender period.
So your money is essentially locked up for years unless you're willing to pay a big penalty.
Effectively, yes. And those charges exist partly so the insurance company can recoup the high commission they likely paid the salesperson up front. They need your money to stay put for a while to make the math work for them.
That's a huge risk if your life changes unexpectedly and you suddenly need access to that cash. Liquidity is a big issue then.
A very big issue. Not flexible products, generally speaking.
Oh, okay. Now, one thing that's often mentioned as a plus is tax deferral. Money grows without being taxed until you take it out, like in an IRA or 401k. That is good, isn't it?
Tax deferral itself is a benefit, yes. It lets your earnings compound faster because you're not paying taxes along the way. But here's the crucial point that came up repeatedly.
What's that?
Your traditional retirement accounts, your 401k, your IRA, TSP, if you have it, they already give you that exact same tax deferral.
Right. So if I put an annuity inside my IRA,
You're essentially paying annuity fees, those extra costs we talked about, for a tax benefit you were already getting for free just by having the IRA.
so it's redundant. Paying extra for no added tax benefit.
Completely redundant in that context. It just adds cost and complexity without any additional tax advantage. One source called putting a simple fixed annuity inside a tax-deferred account, like a 403(b), absolutely screwed up for that very reason.
Wow, that's a really important warning. Don't pay for tax deferral you already have.
Yeah.
Okay, so considering all these downsides, the high cost, the complexity, the conflicted sales incentives, the locked up money via surrender charges, the redundant tax issue in retirement accounts, gosh, when would an annuity actually make sense? Especially for our listener who's new to this.
Well, based on the analysis, it seems like they really fit best in pretty specific, maybe even narrow situations.
Like what?
Primarily, it's for people who put an extremely high value on guarantees, either guaranteed income they can't outlive or guaranteed protection of their principal from market losses. And crucially, they need to understand and accept the trade-offs involved, the costs, the lack of access.
So maybe someone who is just incredibly risk averse, like terrified of seeing their account balance drop, even if they know markets recover.
Exactly. You sometimes hear the term sleep insurance. For someone whose fear might cause them to panic and sell at the worst time, maybe the cost of a fixed or indexed annuity that prevents that panic is worth it to them. Even if it's not the optimal financial move on paper, it's about managing their emotional response to risk.
Okay, peace of mind being the primary product almost. What other scenario?
The other classic one is someone already in retirement or very close who needs to turn a lump sum of savings into a reliable, predictable income stream that will last their lifetime, like creating their own pension. An immediate annuity or maybe a deferred one with an income rider can do that.
So it fills that specific income for life need if you don't have a pension.
Right. Though it's worth noting, if you already have a solid pension and Social Security, your need for this particular feature might be lower.
Okay. Any other cases? Maybe like winning the lottery or getting a big inheritance.
Yeah, sometimes they're considered for structuring large, sudden windfalls into manageable long-term income. And there are some specialized uses in complex long-term care planning, but that's getting even more intricate.
It really sounds like these are niche tools, though. You absolutely have to weigh that desire for a guarantee against all those negatives we talked about, the cost, the complexity, the lockup.
That is the absolute key takeaway. It's a balancing act, and it's definitely not a product for everyone, maybe not even for most people, particularly if you're still years from retirement or if you need flexibility with your money. The complexity alone is a huge hurdle.
Right.
If you are ever considering one, you absolutely must commit to reading and understanding that entire contract. Every fee, the surrender schedule, how the interest or gains are actually calculated, the limits, the rider details, everything. Before signing anything.
And check out the insurance company itself.
Crucial. Their promise to pay you back decades from now is only as good as their financial strength and stability.
So for our listener just starting out, the big picture seems to be annuities are complex insurance contracts aimed at retirement income or principal protection.
Right.
They offer things like income guarantees, market protection sometimes, tax deferral. But the downsides are serious. High costs, confusing terms, potential conflicts of interest in sales, surrender charges, locking up your money.
That sums it up really well. They are not just another investment like a stock or a bond. Whether one makes sense is intensely personal, depends entirely on your specific situation, your goals, how comfortable you are with risk, and what other income sources you have. Definitely not one size fits all.
It sounds like something you shouldn't decide on lightly or alone.
Absolutely. Getting advice from a qualified financial advisor who is a fiduciary, meaning they have to act in your best interest and who looks at your whole financial picture, is really critical before going down this road. They can help you see if an annuity fits or if there are simpler, cheaper ways to reach your goals.
Yeah. This conversation has been really helpful, I think, in mapping out the territory, the different types, why they're so popular now, but also shining a bright light on those significant drawbacks and the very specific cases where they might fit. It really hammers home that point. Guarantees sound nice, but you have to look incredibly closely at what you're paying for them.
Couldn't agree more.
So let's wrap this up. Annuities. They're financial contracts with insurance companies, primarily for retirement income or principal protection. The key thing for you to wrestle with is balancing that promised guaranteed income, maybe market protection against the realities. Potentially high fees, commissions influencing sales, very complex contracts, and those surrender charges that can lock up your money for a long time.
And remember, suitability is totally individual. It hinges on your personal finances, your goals, your tolerance for risk, and other income sources like Social Security or pensions. They're complex tools for specific jobs, not a general recommendation.
Absolutely. Requires serious homework. Which leaves us with a final thought for you to consider, especially regarding those indexed products, the FIAs and RALAs, that offer market-linked returns with some downside protection.
Yeah, think about this. Even with those products trying to give you market exposure while limiting losses, given the potential for high fees, the caps on your gains, the participation rate limits, and those long surrender periods, how much is that guarantee or protection really costing you over the long run, especially compared to other, maybe simpler and cheaper ways to invest? Is that peace of mind or that limited protection worth the price tag?
That's the million-dollar question, maybe literally. We'd genuinely love to hear what you think. Do you have experience with annuities, thoughts you want to share, questions this raised? Let us know down in the comments.
Yeah, your insights help everyone learn. And hey, if this exploration helped clear things up a bit about annuities, please do give us a like and subscribe to Marginal Thoughts. It really helps us keep bringing these kinds of conversations to you.
Thanks so much for joining us today. We'll see you next time.